Hi, my name is Brandon Vecchio, and I'm in the Academy of Finance at Northwest High School here in Omaha. Could you explain the criteria you look at when selecting your stocks?
Well, we look at, and I'm glad you came. I hope there's a large group. I got a note, I think, from your teacher on that. We look at it. The criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it means the earning power over the next 5 or 10 or 15 years is likely to be good and getting better or poor and getting worse. But try to evaluate that future stream. And then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I said last year, what we do is simple but not necessarily easy. The checklist that is going through our mind is not very complicated. Knowing what you don't know is important, and sometimes that's not easy. And knowing the future is definitely it's impossible in many cases in our view, and it's difficult in others, and sometimes it's relatively easy, and we're looking for the ones that are relatively easy. And then when you get all through, you have to find it at a price that's interesting to you, and that's very difficult for us now, although there have been periods in the past where it's been a total cinch. And that's what goes through our mind. If you were thinking of buying a service station or a dry cleaning establishment or a convenience store in Omaha to invest your life savings in and run as a business, you'd think about the same sort of things. You'd think about the competitive position and what it would look like 5 or 10 years from now and how you were going to run it, who was going to run it for you, and how much you had to pay. And that's exactly what we think of as when we look at a stock, because a stock is nothing other than a piece of a business. Charlie?
Yeah, if finance were when finance is properly taught, it should be taught from cases where the investment decision is easy. And the one I always cite is the early history of National Cash Register Company. That was created by a fanatic who bought all the patents and had the best sales force and the best production plants. And, he was a horse in the best production plants. He was a very intelligent, was a godsend to retailing when cash registers were invented. So that was the pharmaceuticals of a former age. If you read an early annual report prepared by Patterson, who was CEO of National Cash Register, an idiot could see that this was a talented fanatic, very favorably located, and that therefore the investment decision was easy. If I were teaching finance, I would collect 100 cases like that. And that's the way I would teach the students.
We have that annual report. What was that, 1904 or something, Charlie? But it's really a classic report because Patterson not only tells you why his cash register is worth about 20 times what he's selling for to people, but he also tells you that you're an idiot if you want. But he also tells you that you're an idiot if you want to go in competition with him. It's a classic, dude.
It is just a total report and not realize that this guy can't lose.
Good afternoon, gentlemen. My name is George Donner from Fort Wayne, Indiana. My question has to do with estimating the intrinsic value of a company, in particular the capital-intensive companies like you were mentioning. I'm thinking of things like McDonald's and Walgreens, but there are lots of others where you have a very healthy and growing operating cash flow, but it's largely or completely offset by heavy expenditures on putting up new stores, or restaurants, or building a new plant. And so my question is, what do you do for your estimate of future free cash flow? And with long treasuries around 6%, at what rate do you discount those cash flows?
Well, we discount at the long rate just to have a standard of measurement across all businesses. But we would take the company that is spending the money as it comes in, and they don't get credit for gross cash flow. They get credit for whatever net cash is get left every year. But of course, if they're spending the money wisely, even though you have to discount it for more years, the growth in cash development should offset that, or they weren't investing it wisely. The best business is one that gives you more and more money every year without putting up anything to get it, or very little. And we've got some businesses like that. The second best business is a business that also gives you more and more money. It takes more money, but the rate at which you reinvest the money to get that growth is a very satisfactory rate. The worst business of all is the one that grows a lot, and where you're forced in effect to grow to stay in the game at all, and where you're reinvesting the capital at a very low rate of return. Sometimes people are in those businesses without knowing about it. But in terms of discounting, in terms of calculating intrinsic value, you look at the cash that is expected to be generated, and you discount back. In our case, we use the long-term treasury rate. That doesn't mean that you pay the amount that present value calculation leads to, but it means that you use that as a common yardstick, that treasury rate. And that means if somebody is reinvesting all their cash flow the next 5 years, they better have some very big figures coming in down the road, because at someday a financial asset has to give you back cash to justify you laying out cash for it now. Investing is the art, essentially, of laying out cash now to get a whole lot more cash later on, and something at some point better deliver cash. Ben Graham in his class we used to talk about what he called the Frozen Corporation. The Frozen Corporation was a company whose charter prohibited it from ever paying anything to its owners, or ever being liquidated, or ever being sold. And
Sort of like a Hollywood producer.
yeah, and the question was, what was such an enterprise worth? Well, that's sort of a theoretical question, but it forced you to think about the realities of what business is all about. And business is all about putting out money today to get back more money later on. Charlie?
I do think there is an interesting problem that you raised, because I think there is a class of businesses where the eventual cash back part of the equation tends to be an illusion. I think there are businesses where you just keep pouring it in, and then all of a sudden it doesn't work and no cash comes back. And what makes our life interesting is trying to avoid those and get on the alternative kind that drowns you in cash.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements and merely staying in the same place. And there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people to sell lots of merchandise in recent years.
It's not to the credit of the investment banking fraternity, but it has learned to speak in terms of EBITDA. I mean, the idea of using a measure that you know is nonsense, and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.
The question I want to ask is, how do you calculate the intrinsic value of the company? And based on intrinsic value, to me, Berkshire Hathaway looks a great bargain at these prices, especially based on look-through earnings. Is that true? And one last question I want to ask, just for fun. What do you think about telecom IPOs like Quest, US-like? They seem to pop up 50% at opening. Does it make any sense to invest in these? Thank you very much.
I didn't follow that all. Intrinsic value, we give you the facts and you make your own conclusions. I like the fact that you think we're honest, but if you people keep bidding up the price of our stock, honesty will only do so much for you in the future.
Yeah, we've never been tested. I mean,
Yeah.
we're very lucky. We've never had anything that we needed really that we haven't had. And who knows what the situation would be if your family was starving or something. And so our intention is to continue in a position where we'll never be tested too, I might add. The intrinsic value question, I mean, by definition, intrinsic value is the present value of the stream of cash that's going to be generated by any financial asset between now and doomsday. And that's easy to say and impossible to figure, but it's the kind of thing that we're looking at when we look at a Coca-Cola, where we think it's much easier to evaluate the stream of cash that comes in the future than it is in a company such as Intel, marvelous as it may be. It's easier for us. It may not. Andy Grove may be better at figuring out Intel than Coke. And in Berkshire, it is complicated by the fact that we have no business that naturally employs all of the capital that flows to us. So it is dependent to some extent on the opportunities available and the ingenuity used in when that cash pours in, as it does. Some businesses have a natural use for the cash. Actually, Intel has a good natural use for the cash over time as they've expanded in their business, and many businesses do. But we do not have a natural use. We have some businesses that use significant amounts of cash. A flight safety will buy a lot of build a lot of simulators this year, and they cost real money. But in relation to the resources available, we have to come up with new uses, new ways to use cash, and that makes for a more difficult valuation job than if you've got. Well, the classic case used to be a water or electric utility where the cash could be deployed and the return was more or less guaranteed within a narrow range. And it was very easy to make calculations then as to the expectable returns in the future. But that's not the case at Berkshire. We've got very good businesses, both directly and partially owned, and those businesses are going to do well for a long, long time. But we do have new cash coming in all the time, and sometimes we have good ideas for that cash, and sometimes we don't, and that does make your job more difficult in terms of computing intrinsic value.
Hello, Mr. Buffett, Mr. Munger. My name is Robert McCormick. I'm from Holdridge, Nebraska, and I would like to know how much you attribute the gains enjoyed by the stock market these past years to the baby boomer generation investing for their retirement.
I would say that personally, I would not think that has much to do with it. I think the two big factors, well, there's three big factors. One is the improved return on equity, which was a fundamental factor that pushed stock prices up. Two is the decline in interest rates that pushed stock prices up. And then finally, stock prices advancing themselves brings in buying. It doesn't go on forever, but it creates its own momentum to some extent if you have these underlying factors that started to push it along. So I would say two of the three factors are fundamental, and the third is a market type factor that bull markets do feed on themselves. And I think that you've seen some evidence of that. But I don't think that any specific, the 401k factor or whatever it may be was it by itself. But I do think money is pouring into mutual funds, for example, because people have had a very favorable experience with those funds, and that does bring investors along. People want to be on the train. Charlie? And I think, incidentally, many of them have very unrealistic expectations.
Yeah, the general investment experience in the last 18 years in common stocks has been awesomely high. I think by any past standards now, isn't that right, Warren?
Right. Well, you've had since 1982, you've had roughly tenfold in the Dow and probably similar in the S&P. And with a huge amount of money and with more participants all the time. And there are people coming into the market every day because they feel that they missed the boat or they're coming in heavier than they came in before simply because they've had a pleasant experience. And past experience does not mean much in terms of what you should expect from your investments. You will do well in your investments because you own or bought things at the right price and the businesses behaved well from that point forward.
Well, you won't have 18 more years at 17 or 18% per annum. That I think we can virtually guarantee.
Oh, and it's probably pretty unfortunate because I've been an admirer of Andy Grove and Bill Gates, and I wish I translated an admirer of Andy Grove and Bill Gates, and I wish I translated that admiration. And I don't know what that world will look like in 10 years. And I don't want to play in a game where I think the other guys got an advantage over me, and the other guys got an advantage over me, and I could spend all my time thinking about tech. I wouldn't be the 100th or the 1,000th or the 10,000th smartest guy in the country in looking at those businesses. So that is a 7 or 8 foot bar that I can't clear. There are people that can clear it, but I can't clear it. And no matter how I train, I can't clear it. So the fact that there will be a lot of money made by somebody doesn't bother me really. And I mean, there may be a lot of money made by somebody in cocoa beans, but I don't know anything about them. And there are a whole lot of areas I don't know anything about. So, more power to them. And I think it would be a very valid criticism if Charlie and I, if it were possible that Charlie and I, and by spending a year working on it, could become well enough informed so that our judgment would be better than other people's. But that wouldn't happen, and it would be a waste of time. It's much better for us to swing at the easy pitches. Charlie?
Whatever you think you know about technology, I think I know less.
That's probably not true, incidentally. Charlie has a little more of he understands some things in the physical world a lot better than I do. But